One of the opportunities the non-interest finance market brings to emerging economies like Nigeria is the ability to catalyze socio-economic development. From supporting infrastructure investment and promoting economic empowerment, non-interest finance provides immense opportunity for a teeming Nigerian population with a demography dominated by young people. It therefore brings to the fore the need for effective guidelines that can encourage innovation and increased activities for the non-interest finance market. Joining us for this edition of Islamic Finance Weekly to discuss prospects for the growth of non-interest banking and financial services in Nigeria is the Deputy Director Banking Supervision Department of the Central Bank of Nigeria, Mr. Ahmad Barau. Thank you for honoring our invitation.
Yeah, thank you very much. It's a pleasure coming to this forum.
You're welcome. Non-interest bearing instruments are a detour from conventional money market assets. From your perspective, how can the books of lending institutions that do not charge interest rate be managed effectively?
Okay. Let me start this way. Lending institutions, whether interest-based or non-interest-based, we adopt a similar methodology in managing their books. There's first the same supervisory process, the same supervisory intervention framework. Also, they also face the same prudential guidelines. They also face the same standard, like the IFRS standards, as well as the Basel standard on capital. However, we really need to know that there are some peculiarities when it comes to lending institutions that are non-interest based. Particularly, when you look at our prudential guidelines, we really had to do some adjustment just to take care of non-interest-based institutions. As a matter of fact, we had to, at a point in time, lower their liquidity ratio from 30% to 10%. Simply because we have realized that a non-interest financial institution, they have serious challenge of liquidity management instruments. So because of that, we had to lower the liquidity ratio. Yeah. And not just the liquidity ratio, but there are some other prudential requirements that we have to take it just easy with those institutions. When you compare with the conventional banks, it's not really as rigorous as we take for the conventional banks.
Yes, you talk about that we need to lower the equity ratio for the non-interest banking.
Liquidity ratio lower there because the liquidity management instrument that are non-interest based.
Non-interest based.
Yes, they are really not there. They are very scarce. Okay. They are not really there. They are not really there. So because of that, and the idea of liquidity ratio is that at any point in time, banks are expected to keep their deposit. 30% of their deposit are in a very liquid or near cash form. So for the conventional banks, they have no problem. They have a treasury base where they can easily invest. But when it comes to the non-interest bank, because of the interest-bearing nature of those instruments, they can't do that. And we just find that they can only keep that 30% of the deposit in only cash form. And that cash form is actually doesn't generate any form of return. And bear in mind that non-interest bank, they normally call it their deposit for investment. So on the other side, the investors who have deposited their amount based on investment, they expect return. And this is bank on the other side, we said that they should keep their 30% of their deposit in liquid form. They can only keep it in cash form, and that doesn't generate anything. So that has serious impact on their profitability.
Profitability.
Okay. Yes, so it is because of that the bank and the CBN decided to lower the liquidity ratio of such institutions to 10%. Yeah. So at any point in time, they are just required to keep 10% of their deposit, investment deposit in cash form. Then another thing that was done also for the exclusion of their deposit for investment from the computation of their CRR, that's cash reserve ratio. You know, banks, when they deposit, when they make deposit, 27.5% of that deposit is actually quarantined, so they have no access to that. It's quarantined by way of cash reserve requirement of the CRR. So, but we have realized that non-interest banks deposit, especially those that deposit for investment under the Mudaraba contract, they actually they have a profit sharing. So, because of that, a decision was actually taken that their CRR, those type of deposits should be excluded from CRR. So we don't really take CRR on such investment that based the deposit that's deposit based on Mudaraba. So we don't really take CRR on such deposit. We only take CRR on their normal current account, that those deposits that are made based on current asset. So for those, we do take CRR.
All right, Mr. Ahmad. Yes. So from a monetary policy point of view, how does the current interest rate regime affect these lenders?
Okay. You see the irony of the MPR, the monetary policy rate. Whenever there's a change in the policy rate, okay, especially when it is the upward review, when the MPR rate is increased, the effect is almost instantaneous in the market. You see the commercial banks increasing their interest rate because of the increase in the MPR. But when it is the other way, when the MPR is reduced, it's actually very sticky. You don't see that coming into effect. The lending rate doesn't really reflect that. So it's actually very sticky, the downward. So I see the MP. That's my own personal assessment anyway. It's not really very. It's my personal assessment. It's not really very. Okay, let me say the rate, especially when it is reduced downward. It's actually very insensitive now to MPR to MPR. It's actually very insensitive to MPR when it is reviewed the downward. But then you see the way the MPR affect those lending institutions when there's a review. Normally, the non-interest lending institution, they try to benchmark their profit rate with their competitors in the market, the conventional banks in the market. They normally try to benchmark their returns, just because of competition. They don't lose customers. So by so doing, when the interest rate of those commercial banks increase, there's also tendency for them to follow. So they always try to benchmark their rate with what the deposit money banks are actually charging. So invariably, I can say the MPR rate, when there's an upward review, it also reflects in the lending rate, or let me say in the financing rate of the non-interest-based institutions.
Since non-interest lending institutions do not have net interest income, is it possible for the Central Bank of Nigeria to still pass through loanable funds to borrowers through non-interest lenders?
It's quite possible. I think we have just seen recently with the intervention program that the CBN has done. So it's quite possible by creating this form of intervention program where CBN pass those funds to the non-interest, especially those intervention funds that are non-interest based. The CBN can pass those funds to the institution through some approved or agreed contract between the bank and then the CBN, and then the bank on the other side can also do some financing. To the obligors. So at some spread, which comes to the bank.
Yeah, a sound financial system is critical to economic growth, and which enhances the performance of the players by improving the overall welfare of the people. So how can interest rate incentives be deployed to influence the credit decision of non-interest banks?
Okay, yeah, I think through this intervention program, I see an incentive really for the non-interest financial institutions. One, because the fund, the intervention fund that are given to those institutions.
Yes.
You find that most of them, the spread is as high as 7%. The funds are given to those institutions by the CBN at some at 2%, at the profit rate at 2%. While on the other side, the banks are allowed to do a financing of up to 9% because they are expected to maintain single-digit interest rate. So you can see that the spread in the profit rate is about 7%. So, and that gives an incentive for the bank to undertake such kind of credit risk. So honestly, I see through the intervention program there's an incentive. In fact, banks the non-interest institutions are incentivized to give financing to the obligors by making use of such an intervention fund.
So how will the recently launched 11 intervention schemes aimed at increasing access to finance deepen the non-interest finance market in Nigeria?
Okay, in a number of ways. You see, the market as we have is actually shallow in both number of institutions and products. Now, with these 11 programs coming to the marketplace, that means 11 products are already coming into the non-interest banking space. And that's obviously is going to increase the number of product availability that we have, and also in terms of reach, is going to reach a lot of customers. Prior to the intervention program, we had some customers that were virtually excluded because of some other factors that they wouldn't want to go into other form of intervention because of the interest-bearing nature of those interventions. But with this interventions coming into play, we are going to have increased number of products that are available to the customers. So customers can evaluate all those intervention programs and see which segment that fit them better. So, and those customers that were prior to the intervention were excluded can now be brought on board because they have seen a product, or they have gotten a product now that can meet their requirement. So through that, it's actually going to help in deepening the non-interest banking space, especially in the as far as the products are concerned. Although the institutions will still be there. They are quite few. They are not, the depth is still shallow. But in terms of our product, I think it's going to really help in deepening the non-interest banking space, as well as the patronage and also the inclusion.
I believe that the effort of the Central Bank of Nigeria, I believe that the effort of the Central Bank of Nigeria is to improve access to finance for the non-interest financial institutions and promote financial inclusion in the country. Thank you very much, Mr. Ahmad, for those insights. Now that we have only 2 full-fledged Islamic banking in Nigeria, what are those key things that will transform non-interest bank space in the country?
Okay, fine. If you see I think on that, we really need to have a very viable and enabling environment. There are some key challenges in the industry, and unless we're able to clear those challenges, I think we continue to have some major problems. And one key issue is, and I keep just hammering on that. So this issue of the liquidity management instrument is actually a real challenge, because it affects the profitability of our banks, and because of that, it actually takes it takes time. Okay, let me just put it. Before they even started, like for a bank coming on board, just newly licensed bank, it actually takes some time before they begin to report reasonable level of profitability, and this is simply because the liquidity management instruments that are so viable for them are not really there, unlike their conventional counterparts. So we really need to have some instrument like the treasury scoop in place, where our institution, in addition to creating or financing risk asset, they can as well also take the advantage of going into investment into those security, those treasury scoop, and by so doing, they boost their profitability. Really. So yeah. So honestly, the enabling environment is the key issue. The key issue. So we really need to have some viable liquidity management instrument in place, where the bank can invest and make some reasonable return. And honestly, by so doing, if we by so doing, I expect to see some investors taking interest in coming into the non-interest banking space. Though the CBN has done a lot already, it has done a lot in that regard. Even for the capital requirement for the sector, you can see is actually low compared with the deposit money bank, the conventional bank. We want to set up maybe a new regional bank, which is conventional. You need about 10 billion just to start, but for the regional non-interest, just about 5 billion. So those are measures really that are put in place just to encourage investors to come into that space. But really, investors may not really come until they are able to see the success stories of those that of the first players in the field. So, and that success story cannot really come when the investment avenue, let me put it that way, for those first players are actually very limited, because for now the only investment they can do is the creation of the risk asset, that is financing of the obligors, and that has some it has its own the kind of say the demerit. It has some its own demerit really, because in times of economic downturn, it has so many externalities. Let me just put it that way. So, but if there are some other avenues that are viable enough for investment, they can actually have a diversified portfolio, really. So that at the end of the day, their returns will be better. Yes. Their risks will also be substantially reduced.
Okay.
And we begin to see those institutions performing well, and that would be an incentive also for investors really to come into the field. Exactly.
Yeah. Like you rightly said, there is need to create an enabling environment and put in place liquidity management for increased investment.
Yeah, viable liquidity management instruments. Viable, exactly. That's what viable is. Not just any form of liquidity management, but that's the viable liquidity management instrument. Yes.
Thank you very much for those insights. What is the way forward for the supervision of non-interest banks in Nigeria that can deepen Islamic banking in the country?
Okay, fine. Honestly, the way forward is just for us to strengthen our own supervisory framework, just to ensure that our banks are guided by the international standards, especially the accounting standard, like the IFRS accounting standard. Though we have the equivalent now developed by IOP. So when I say IOP, the IOP standard, yeah. And when also we also the banks also need to be guided by the Basel capital requirement, Basel III capital requirement, which is also the equivalent of the non-interest finance bank is also available as the IFRS 15 and 16. Those are standard for capital requirement and disclosure requirement. So I think we really need to just strengthen this supervisory process by incorporating all those standards that take the peculiarities of our non-interest financial institution. So that at the end of the day, we end up with institutions that are strong, they are stable, that they are healthy, and we'll also encourage. In fact, you see why the international standards become very, very, very important is because investors anywhere, especially the accounting standard, anywhere is a common language. You see, they can take that accounting information of any institution and interpret very easily because of the standard. And investors from any other part of the globe can make their own informed investment decision based on those accounting information that they have seen for that bank, based on the Islamic non-interest banking space in the country. So I think in summary, we just need to strengthen our supervisory framework by integrating those international standards. And exactly, standardization, but particularly on the capital requirement and disclosure requirements. Yeah. So those are really key, and I think that should be the focus of our supervision.
See, at the end of this conversation, many will want to know how the non-interest banking will benefit them and support Nigerian economy. What advice do you have on this?
Okay, good. Honestly, you see, Islamic banking is the best form of banking in terms of real sector development, because every transaction in an Islamic bank must be backed by an underlying real asset. Unlike the commercial, the normal conventional banks, where transactions are just based on papers.
While Islamic finance is based on asset-backed.
Based on asset, yeah, based on asset. So for me, I think Islamic banking is Islamic finance product is the best option for a country like even in Nigeria. If I just take this book as an example, you see, you raise money, fund through school, and part of the requirement of school is that you have to channel the proceeds of that school to the venture which you said you are going to finance. So by so doing, the issue of diversion of funds and so on and so forth is actually resolved, which is really very, very, very common. So if we can leverage on school issuance to finance our infrastructure, that would be great. So I see Islamic finance product to be a very, very viable alternatives for developing our real sector, as well as our infrastructure development. So we really need to embrace that.
From your point of view, the alternative finance is the main option to fund infrastructure in the economy.
Exactly, and also the real sector. Also the real sector, industry in the real sector, really.
Thank you for sharing your time with us. We appreciate, sir.
Okay, thank you very much, sister. Thank you very much. I'm so grateful.
When talking about practice of Islamic finance in Nigeria, the challenges it faces stems from the absence of Sharia-compliant liquid investment instruments. It therefore calls for standardization and increased awareness as part of the key elements that will facilitate the growth of industry in Nigeria. The benefits of Islamic financial services on the economy include market deepening, financial inclusion, enhanced investment in the critical sectors of the economy, and development of the real sector through its asset-backed financing, which will avail funds only to productive and real investment activities. And that brings us to the end of today's program. Join us next week for another topic on Islamic finance. For questions and comments, please do send to an email to importer@WebTVNG.com. You can also engage us on social media platform displaying on the screen. Thank you for watching and do have a nice day.